Okay, let's unpack this. Imagine you're paying rent, scrolling through options, and there it is. Pay with credit card.
Right.
Seems simple, maybe convenient, get some points.
Uh-huh.
But we're taking a deep dive today based on this really interesting analysis by economist Dr. Pooyan Ghamari. He argues this small act, well, it points to some massive shifts in the economy.
That's exactly it. The first thought is probably personal finance, right? Manage cash flow, maybe snag some rewards.
Sure.
But this work digs much deeper. It looks at how this one transaction, paying rent with a card, actually reveals these bigger, more complex economic forces.
And the risks, too, I imagine.
Oh, absolutely. The risks, the incentives, the wider implications. Our mission here is really to cut through that surface level and show you what's most important from this expert view.
Right, because like you said, it feels very personal, almost mundane. But the article connects it to this bigger trend. What's it called? The financialization of basic needs.
Yes, exactly. And that's a really critical idea here. It's this concept that essentials, things we absolutely need, housing, healthcare, even education, are getting processed more and more through complex financial systems, through credit, and paying rent with plastic. It's presented as like a prime example of this trend weaving itself right into our daily lives.
So it's not just another way to pay, it's maybe a symptom, a sign that these fundamental costs are getting tied up in finance.
Precisely. From the macroeconomic angle the source takes, it suggests a shift in how we as individuals approach spending.
How so?
Well, it's moving away from what they call cash flow-based decisions, basically, do you have the money right now,
Okay.
towards something more like leverage-based consumption. The focus shifts to how you access money, maybe using credit lines, even for stuff you absolutely have to pay for, like rent.
That definitely sets a different kind of stage. But okay, let's step back a second. Practically speaking,
Yeah.
can you actually do this? Is paying rent with a credit card widely possible?
Yes, absolutely. And according to this analysis, it's becoming more and more common, more accessible. There are a few main ways it happens.
Okay, so what are the common routes? How are people actually doing it?
Well, the article highlights a few key pathways. First, you've got some larger property managers or real estate platforms starting to accept cards directly.
Makes sense. More integrated.
But, and this is a crucial detail, the source emphasizes expect fees, processing fees, usually somewhere between, say, 1.5% and 3% of the rent amount.
Ouch. Okay, that immediately changes the calculation on whether it's worth it for points or convenience.
It definitely does. Then there's another common way, especially if your landlord isn't set up for direct card payments. That's using third-party platforms.
Ah, like intermediaries.
Exactly. Services like Parent, Rent Track, Plastic, you pay them with your card, often for a fee again, and they cut a check or send a bank transfer to your landlord.
Right. I think the article mentions specific examples, too. In places like Dubai, payment gateways becoming more standard there.
They are, yeah. In markets like Dubai, big real estate portals, A-Land, Bayut, Property Finder, they're integrating digital payment gateways, often partnering with fintech companies.
So credit card options are just built in.
Increasingly, yes.
Yeah.
Making it feel much more seamless within that whole online renting process.
Okay, so the how is clear, possible, increasingly easy, but usually involves fees. Now, the big question the source digs into, when does this actually make economic sense? Because like you said, just because you can doesn't mean you should.
Exactly right. This isn't painted as a one-size-fits-all solution. It comes with some very specific strategic filters.
What's the first filter? When might it work?
Cash flow management. That's one scenario. Using a credit card lets you essentially shift time. You use the bank's money now, pay your rent, and your actual cash outflow happens later when the card bill is due.
Okay, time-shifted capital.
But the source frames this very clearly as an advanced maneuver. It's not a Band-Aid for just not having the red money.
That feels like a really important distinction. It needs certain conditions to work, right?
Absolutely critical conditions. This strategy, according to the analysis, only really works if you genuinely have, say, fluctuating or seasonal income.
Okay.
And this is key.
Yeah.
You have access to maybe a 0% introductory APR period on that card.
Right.
And you have absolute certainty and, frankly, the discipline to pay off the entire balance when it's due. Every single time. Without all that lining up perfectly, you're walking into a potential debt trap.
So it's a tool for managing predictable timing differences, not for covering shortfalls.
Got it. What's another potential upside the article talks about?
Leveraging rewards. Credit card points, miles, cash back. This is often the main attraction for people.
Just a perks.
Yeah. Premium cards, especially, can offer pretty substantial rewards on large, regular payments, like rent, assuming you're using an approved platform or method.
And on a big rent payment, that could actually add up to something meaningful.
It potentially could. The article gives a specific example, actually. Say AED 8,000 a month in rent. If you have a card giving 2% back in real value.
That's nearly AED 2,000 a year, just from paying rent. For certain people, maybe global professionals, frequent flyers that could mean free flights, upgrades, real value that helps offset living costs.
That's definitely tangible. What about the third benefit mentioned?
Building credit history. This can be particularly useful for, say, expats, people new to a country, or really anyone trying to build up a solid financial record quickly.
How does paying rent with a card help there?
Well, consistent, on-time payments are key to a good credit score. Even if it's paying off the credit card bill you use for rent, it shows responsible credit usage on a significant recurring expense.
And the article mentions specific systems, like in the UAE, where this kind of visibility is important.
It does, yeah. In systems where your credit profile is often tied to things like a national ID. The Emirates ID in the UAE example, using credit strategically and responsibly for major payments like rent, and crucially, paying it off promptly, can help build that positive credit footprint faster than maybe just smaller miscellaneous purchases.
Okay, so we have specific scenarios. Disciplined cash flow timing, maximizing high-value rewards, or strategically building credit. But the source is also very clear, isn't it? The risks are huge and often outweigh these upsides for most people.
Absolutely. This is where the conversation gets, well, frankly, a bit scary. The economic realities can be harsh. The number one risk the article hammers home is the danger of high interest rates and compound debt.
Right. What happens if you don't pay that full balance off by the due date?
That's the nightmare scenario. Your rent payment, which should just be a fixed monthly expense, suddenly becomes high-interest debt.
And credit card interest is steep.
Extremely steep, often 20%, 25%, even 30% APR annually. The article really stresses that this completely breaks fundamental financial sense. You're turning a basic living cost into a rapidly growing liability.
So that initial convenience or those few points suddenly cost you an absolute fortune.
Precisely. And then there are those processing fees we talked about, the 1.5% to 3%.
Yeah.
As the article points out, you have to do the math rigorously. If the fee is, say, 2.9% and your card only gives you 2% back in rewards, you're literally losing money on every single rent payment. The math has to work out strongly in your favor after accounting for every single cost. No exceptions.
It really forces you to be your own meticulous accountant for just paying your rent.
It really does.
Yeah.
The source also brings up a more, maybe, psychological risk.
Yeah.
Dependency, creating a kind of financial illusion.
How does that work?
If you start relying on credit for rent without that solid repayment plan, it can
Right.
make you feel like you have more liquid cash than you actually do. You're just pushing the payment down the road, right?
Right. Delaying the inevitable.
Exactly. But the debt is quietly racking up on the credit card statement. It creates this false sense of financial breathing room while the underlying debt grows.
That sounds like a really easy trap to fall into.
It can be incredibly dangerous. And there's a bigger picture warning here, too, from a macroeconomic perspective. If we see widespread use of credit cards for rent payments becoming the norm, the article suggests it could be a red flag.
Yeah.
It might signal underlying problems like wages not keeping up with living costs or inflated housing prices forcing people towards expensive credit just to cover essentials.
So it's not just about smart consumers optimizing points. It could be a sign of economic strain.
It could be. It raises the question, are people using credit for rent strategically or out of necessity? That's a concerning signal about broader economic health.
That connection between individual choices or struggles and these macro signals is fascinating. Now, the article zeroes in on Dubai as a kind of, what did it say, live laboratory for this whole trend. Why Dubai?
Yeah, Dubai is highlighted because it has this unique mix of factors, according to the analysis.
Like what?
Well, first, no income tax. That potentially means residents have more disposable income, maybe making them slightly less sensitive to those processing fees.
Okay, interesting.
Second, a very large dynamic expat population. Many expats might have income streams that aren't perfectly regular month to month, fitting that cash flow management use case we discussed, if done carefully.
Right, more variable income.
And third, there's just incredibly high adoption of digital payments, mobile payments. People are comfortable using tech for transactions.
So the conditions are just right, for this kind of thing to take off.
Exactly. It creates fertile ground.
Yeah.
And the article mentions specific developments happening there, like platforms A-Land was one example, that are actively building these fully integrated, seamless rental ecosystems where credit payment is just part of the package.
And it's not just about adding a pay by card button, is it? The tech gets more advanced.
Oh, much more advanced. The source talks about integrating things like smart contracts for digital lease agreements, issuing tokenized receipts for payments,
Wow.
using AI for different kinds of scoring, maybe tenant risk or payment reliability scoring, exploring stablecoins for payments,
Yeah.
even using blockchain potentially for enforcing lease terms down the line.
That's incredible. Rent payments moving from, paper checks or bank transfers into the realm of crypto, AI, blockchain.
It shows just how deeply fintech is embedding itself into this traditionally non-digital massive sector.
Which brings us nicely to the macro financial implications the source discusses. From a strategic investor's perspective, what does this whole trend signal?
Well, from that viewpoint, the rising adoption signals a few key things. One, it confirms consumers are increasingly willing to pay a premium those fees for payment flexibility and convenience.
Okay, that's valuable market data.
Two, it underscores just how quickly fintech is penetrating and integrating into these huge traditional industries like real estate. The pace is accelerating.
And it seems like it's potentially creating entirely new financial products or instruments.
Yes, that's a really crucial point from the analysis. It points towards the possible emergence of new credit instruments, specifically designed around tenancy agreements.
Mm.
And this leads to the really interesting concept mentioned, rent-backed securities.
Rent-backed securities. So kind of like mortgage-backed securities, but instead of mortgages, you're pooling rent payments.
That's the basic idea outlined.
Yeah.
Imagine bundling together thousands, maybe millions, of monthly rent payments, even those initially made via credit card, into a single package.
Okay.
That package could potentially be sold to investors as a yield-bearing asset, offering them a new way to get exposure to residential rental cash flows.
Wow. So the money you pay for your apartment each month, maybe charged to your Visa, could end up sliced and diced into some complex investment product trading on the global markets?
It's a potential future evolution the source maps out based on these current trends. It's quite something.
It really is.
And one more thing on the macro level. The article suggests that tracking the rate at which people are paying rent with credit could become a useful predictive tool.
Predictive of what?
Economic strain, especially as central banks around the world tighten monetary policy, making borrowing more expensive. If you see a sharp increase in people relying on high-interest credit cards for an essential like rent,
It could be an early warning sign.
exactly, an early warning signal about consumer financial health, stress in the housing market, and maybe the broader economy tipping towards a downturn.
So this seemingly simple choice, swiping plastic for rent, connects everything from your personal budget discipline to potentially forecasting recessions and fueling new Wall Street innovations.
It's a really powerful illustration, isn't it? How deeply interconnected financial systems are with our everyday lives, often in ways we just don't see immediately.
Okay, this deep dive has been incredibly eye-opening. We've really explored the two sides of paying rent with a credit card. You've got the surface appeal, the convenience, maybe some rewards, versus these deep, complex financial mechanics, the very significant risks, and even these broad macroeconomic signals hiding within it.
And I think the absolute core takeaway from Dr. Ghamari's analysis is this.
Yeah.
It's really not about can you pay rent with a card. The technology is making that easier and easier.
Right.
It's all about when and if and how it makes genuine strategic economic sense for you in your specific situation. You absolutely have to look past that immediate convenience.
You need to do the homework.
You need to rigorously calculate those fees, stare the risk of high-interest debt right in the face, and be brutally honest about your own financial discipline and your ability to pay it off in full, on time, every time.
It demands serious consideration, not just a casual click. And maybe here's a final thought for you, the listener, to take away from this deep dive. Think about how these seemingly small, routine payment choices we all make, whether it's using a credit card for rent or maybe just tapping your phone for coffee, might actually be reflecting or even contributing to much larger economic currents.
Yeah.
From shifts in how we all use leverage to the potential creation of entirely new financial markets like those rent-backed securities we discussed. What other little corners of your daily spending habits might be whispering secrets about the big economic picture?